Kia ora and welcome. We'll kick off in just a moment as everyone filters in. Hope you have a cuppa and are getting comfortable and warm wherever you're coming from. I've got two quick housekeeping bits before we start. First, we're recording tonight. So if you want your partner or a friend to watch, or you find it so riveting you'd like a rewatch, we'll send the recording out tomorrow. And if you're already coaching with us, welcome back. This is a great one to forward to someone who's been sitting on their property decision. So second, any questions, anytime, pop them in the Q&A box. My producer Amelia is behind the scenes collating them, and we'll get to them at the end along with all of those awesome pre-submitted questions. So thank you very much for taking the time to do that. And tonight is a straight up look at whether property still stacks up as an investment here in New Zealand. No hype, I promise, no doom, just the honest picture and what it actually means for you. So, a quick word on who's talking to you tonight. I'm Katie, a qualified financial advisor and chartered accountant with 20 plus years across accounting, investment banking, and consulting. I've built and sold my own business and worked across Europe, the US, and here at home. I've been here at Enable Me for over a decade, and I'm our national coaching lead. My job is simple: optimize the outcomes for my clients and help them reach their financial potential. So we've got a lot to cover off tonight. I will be talking at pace, but remember you've got that recording that will be sent out tomorrow. So here's where we're headed. First, why property investment isn't over, but also why it stopped being a simple yes or no. Second, why the whole plan matters more than any single product. The right mix of KiwiSaver, funds, and property working together. And third, how we actually coach you to build that plan and stick to it over time. To us, getting optimal around your finances is never just a one-off tip, but someone in your corner who has your back for the long haul. By the end, you'll know exactly what a good next step looks like for you, whether you are new to us or are already coaching with us. And a little disclaimer, this presentation is informational only and does not constitute individual financial advice. So this is the question we posed in terms of our advertising for this webinar. Is residential property still a valid investment in New Zealand? Yes. And here's why. Leverage amplifies returns. And when I say that, what do I mean? With property, generally speaking, you'll put in your money, the bank puts in their money, and you keep 100% of that gain. That means that you acquire a bigger asset that goes up in time. New Zealand has a 30-year track record, and property is cyclical like anything. We know that, but you've got a really solid long trajectory. Someone else is paying your mortgage, and again, with property, we believe there are more levers to pull than almost any asset. It's a natural inflation hedge when you have debt. And what do I mean when I say that? In terms of inflation, we know if we've got $1 today, because of inflation, it's going to buy us less next year. But if that is true, the same is true of debt. $1 of debt because of inflation is in effect going to be worth less into the future. And that's important. That's really protective for your position. And in terms of levers, you can add value, restructure debt, refinance, rents rise with inflation. And I'm going to reiterate this. A good investment and the right investment for you are two different questions. Property can be brilliant and still be the wrong move at the wrong price with the wrong structure. And that second question, is it right for you, is exactly what we coach our clients through. And I'll give you some really good tidbits along the way in terms of the questions you should be asking yourself. So, setting the frame. For a long time, as you well know, property felt like the obvious wealth move in New Zealand. Buy something solid, we hold it, let time do the heavy lifting. And for a lot of people, that worked. Like it really genuinely worked. But the question has shifted. It's not just should I invest in property anymore? It's something more specific. Is property still the right move for me from where I am standing right now? And that's a more honest question. And again, let's do some digging in terms of how to answer that, in terms of what is best for you and your family going forward. And we're going to work through that today. And I think it's important to acknowledge why the property conversation feels harder than it used to. And I think it's probably a combination of things, and most of you will recognize at least a few of these. So, like most asset classes, property is cyclical. And in terms of edge of the cycle, property values that they feel flatter. The capital growth we got used to in terms of the upward push in the cycle, that growth is slower, and that does change the dynamics and the math that you're looking at in terms of is the property I hold as my investments at the moment fit for purpose? And should I still be looking at further investing or starting to invest in property? For lots of our clients, retirement is getting closer, and for some of you, the timeline has shifted, and that changes the risk calculation because, as you know, property is a long-term investment. And lending is it's feeling tighter. Serviceability tests are still tough, and the banks are they're asking hard questions. And I think interest rates are getting a little bit harder to predict. We've been through a jarring significant rate cycle, and no one knows exactly what comes next. And we've got in the background this cost of living pressure where holding costs have increased. So we've got rates, insurance, maintenance. So the cost of owning has gone up. And if I'm honest with you, I think markets in general just feel noisier overall. There's a lot of opinion out there. We've got lots of AI kind of regurgitating what you want to hear, and it's really hard to get a signal noise, a really strong signal from all of that noise. It can be really overwhelming in terms of catching, well, what are the right messages for me and what do I do next with confidence? To be clear, none of this negates the advantages around property. None of this means that property is off the table, but it does mean that the decision needs to be really deliberate, more strategic than it might have been even a decade ago. And most advice stops at the what. Buy this, invest in that. But picking the product was never the hard part. The hard part is structuring it properly, fitting it around your cash flow, any debt that you might have, and your goals, and then actually sticking to your plan when life gets noisy. And life will always get noisy. You can never have a plan that is set in concrete, otherwise, it becomes irrelevant to you. So, you need to ensure you have a plan that is flexible enough. So, as life flexes, your plan flexes with it. And that's why we think financial coaching is so important. All of this, it's never a one-off decision or a product, but a plan. And What's really helpful for lots of our clients, and I know that lots of the audience are our clients, is to have someone in your corner who can give you the confidence to act and follow through. And when you look at financial success, about 80% comes down to behavior and 20% comes down to strategy. And that's exactly where a coach earns their keep. And I want to make this really concrete in terms of how property can fit within a wider plan to really maximize your position and give you more options going forward. So I'm going to walk you through an example. So say you've got a mortgage and you'd like to invest while you pay it down. A really common place to be for our clients, not all, but quite common. We'll follow one couple through three different choices, and we'll see three very different outcomes from roughly the same starting point. The difference, it's never luck. It's actually never income. That is an absolute fallacy that the way to get ahead is to earn more. It's not. It's actually ensuring that you capture what's left over and channel it as productively as possible. It's strategy and it's execution. I'm going to introduce you to our model couple. And the couple is, it's very typical of what we are seeing at the moment, with their names freshly minted on the title of their first home after extended period, as you know, of saving up the deposit. So this couple, they're 35 years old, have a combined income of 200K before tax, and are the proud owners of a mortgage or death pledge totaling 600K. It's being paid off over a standard 30-year term, no tricks there. They're quite rightly proud of what they've achieved so far. But as you know, when you buy that first home, it is a grind and they are somewhat wary, uncertain of how they can possibly get ahead and not sure if they'll experience financial freedom again. So let's look at that property question and how it fits into a broader picture of real life when there is noise, you're navigating mortgage, life, etc. And so for Sarah and Mike, if they follow the system that has been laid out for them, they have 30 years ahead of them on the hamster wheel, working so they can make their mortgage repayments. So in terms of zooming out at the broader New Zealand population, on average, we buy our first home at 35, 36, and it takes us 30 years to pay off our mortgage. So that's what the vast majority of New Zealanders are doing. And a sad fact that is little known is that your mortgage repayments remain the same until the day you pay that mortgage off. Interest rates change, obviously, which kind of can change the amounts, but in essence, that is what it is. And the mortgage isn't paid off until that last bitter repayment. And if you're working with us and we've got you mortgage free, well done. You know the delight and freedom and rocks removed from your backpack. But disappointingly, this couple, if they stay on that average trajectory, will also pay around double the value of their mortgage. So that's about $1.2 million. That is what the average Kiwi is doing. So is there another way? And the second outcome we're going to cover off tonight is the option of pulling back on spending by 15% and finding some extra money to invest elsewhere. And that number in this example that I'm trying to bring to life is very deliberate. On average, and our clients will be rolling their eyes, I am sure, on average in New Zealand, we fritter about 15% of our net income. Sit with that. A little bit of overspending, generally a lot of paying too much interest to the bank because our mortgages are inefficiently structured, and a lot of not doing what needs to be done in terms of strategy. So in this example, they are investing in managed funds. And you think, well, how do you do that? You find that money by having a plan, having a goal that motivates you, having a really good structure of control in your finances. That is how you find that money, and often working with somebody external to yourself that you're accountable to. You always lift your game, you do what needs to be done, and you get there in the shortest amount of time. So that 15% is very deliberate in terms of the math. And what could Sarah and Mike achieve in terms of having a little bit of coaching and having that optimal structure and strategy that so many of our clients have? So the third, and we would argue the most superior option, is to take the approach of the mortgage master. So this approach combines being strategic around how you structure and pay off your mortgage, as well as using the power of leverage to grow wealth sooner. And in terms of answering the question, does property still stack up? Yes, it does, as part of a broader plan. And I'm trying to highlight that to you with this example. We never suggest we are tunnel vision and that it's just the one thing. It's usually a combination of lots of different things that ensure that you do have more options and you are protecting yourself in terms of whatever happens next. So, financial freedom for this third path, I'm going to illustrate this, but it comes much sooner than the previous two. So I always think, why wouldn't you? But a coach can work with your unique personality because we're all different so that you get the best results in terms of how do we motivate you? Because everyone has different personality types. You've got to understand how you tick to ensure that you have a plan that's going to resonate and a structure that will support you to make the better decision. Again, success, 80% behavior, 20% strategy. Lots of people just focus on that 20% in terms of strategy. We want to marry the two because that is the thing that gets you ahead. And in terms of looking at the results of these different options, so let's talk numbers. Remember, I'm an accountant as well. Love my numbers. And for today, we're going to round these numbers to keep things simple. So on the traditional path, let's be honest, I think any dreams about spending more time on hobbies or with grandchildren have to be put on hold until this point. The only money in the retirement pot is from KiwiSaver. And we know that the average New Zealand couple will need 900,000 plus extras. So it's far from enough. And I think there is a complacency often when we look at our KiwiSaver, and that's fantastic. I love KiwiSaver. I think it's fantastic. I think if we're honest with ourselves, we wouldn't be saving at the rate that we are in terms of that foundational setup. I am the biggest advocate for KiwiSaver. 591,000 is not to be sniffed at. But in terms of having choice, it's not quite enough. And when you look at that number, you think, well, that feels like a lot, Katie, and it's a significant sum. But remember, on average, Massey University shows that we spend about 75K in terms of a choices retirement. That goes really quickly in terms of retirement because we're retired a very long time. So again, if we retire at 65 to get to 90, that's 25 years. So you can see how that quickly gets used in retirement. And again, let's run through that second pathway with the option of finding that 15% extra and putting it into that diversified investment fund. And honestly, for most of my clients, they do a little bit of both. It's just where do we lean in terms of age and stage, your timeline, and the options available to you. So for purposes of this illustration, we've compounded that 15% annual contribution by 3.5%. So what you're seeing takes into account inflation, fees, tax. Essentially, it's in today's money. Then we let compound interest work its magic. And not too bad, not too bad. So we've got that mortgage-free home at 65. We've got investment funds of 1.191 million and then that KiwiSaver piece of 591,000. Now, this is a retirement with a few more choices, but how do you take that to the next level? So remember, I've been here for over a decade. It has been my job with my clients to serve them, to find that inefficiency in terms of that 15% and channel it as productively as possible. So, for those who are on the call, um, we're calling you our mortgage masters in terms of elevating that strategy. And again, we've got to put in the mahi in terms of getting to this position. But for them, they've paid off their mortgage at 47. They've got 18 years to grow their wealth. So you've just got a longer runway. With that runway, we managed to invest that 71K per annum into investment funds. And what a difference, right? And what you're actually doing is tapping into those magical financial fundamentals. We've got that compound interest piece. So if you have a really good debt reduction strategy in terms of you've stripped out the inefficiency around cash flow and channeled it against the mortgage, that is creating equity that you can tap into to buy another property from an investment perspective. But it also means by paying off that debt earlier, you're reversing the compounding interest that you're paying on that debt, again, giving you more options. And you're also letting time tick on in terms of the investments that you are amassing, but also you're allowing that equity to be used to put a deposit on a property. You're using leverage to buy a bigger asset that appreciates in time. So in this example, mortgage free at 47, at 65, they've got investment property gains of 921K, and that's to buy a good property and holding it. They've got that still that base level of 591K in KiwiSaver, never anything to be sniffed at. And they've also got those investment funds bubbling away in the background. So we are saving thousands of dollars of interest paid to the bank by getting mortgage free faster. We're letting leverage do its thing over the years while we work on diversifying investments even further once mortgage free. And what this really represents to me is freedom. And at Enable Me, we believe that sequencing piece is really important. So often clients will come to us when at varying stages, but sometimes there are trigger points. And sometimes that trigger point is they're about to be mortgage free in their home and they're like, oh, we've been aiming for this for ages. What comes next? And because again, you're never doing one thing. And for some people, they have worked really hard, 20 years, slogged their guts out, paid off their mortgage a bit faster. That is an achievement. But in my mind, we're never ever doing one thing because you think, well, 20 years, 10 years ago, likely you had created enough equity to tap into to purchase another property that could have just bubbled away in the background in terms of gains. And again, I think it's really important to acknowledge when we look at property you don't have an infinite time to faff about, to wonder if it's right for you, to wait for the stars to align, because as you get older, it's harder to borrow money, let's be honest. So there is a window of time when you can. And again, when you go to the bank, they're stress testing it at higher interest rates, etc. That gives us a layer of comfort that you can make this work longer term really interesting in terms of dynamics, and I'm trying to illustrate what a holistic financial view would look like that is not product led. We are not just looking at one thing. I am not telling you property is just the answer. I am not telling you paying off a mortgage is the answer. I am not telling you KiwiSaver managed funds is the only answer. I'm saying if you have the ability to do so, let's pull all of the levers, but what is the sequencing that's right for you and your family in terms of capacity and timelines? And so interesting. So lots of people will challenge me around that mortgage strategy in terms of I could get better returns elsewhere, maybe, my managed funds are going gangbusters. But again, everything's cyclical. Things can dip in the future, and often that mortgage is one of your biggest cash outflows. When it's done, you have more options. And again, just illustrating the difference between paying off a mortgage earlier, um, effectively 223K of interest paid as a mortgage master versus 660K with the traditional path. I know which one I would rather for you in terms of what comes next. So, really fundamental to look at that mortgage structure and strategy as part of that wider plan. We're leaving no stone unturned in terms of what comes next. And again, just really driving this home, comparing the net wealth over those different strategies over and above having that mortgage-free home. So that traditional path, remember we've got that KiwiSaver piece, investing that cash surplus. So again, working with you behaviorally to say, well, let's find that inefficiency, let's flush it out and invest it really wisely. 1.782 million, not to be sniffed at. But in terms of elevation and having more options for my clients, doing it right, buying the right properties and holding them through a cycle, again, that can exponentially move the dial in terms of what you have. And why does it matter? And I wrote an article recently in my stuff column around, or I was asked, is it still about the Beamer and the batch, Katie? And I mean, there's an element of that for some, but actually, I think for the vast majority of my clients, this is about having more choice and more financial freedom. And I don't think anyone gets excited, maybe some niche accountants, I'm not one, about a spreadsheet. I think they always get excited about freedom, and that looks like different things for different people. A happy retirement, choices about the work you do or whether you work at all, and real peace of mind. And again, I've worked with thousands of clients and they are amazing. And I've seen so many benefits that I hadn't thought of along the way. And again, a decade's a long time. I think I've seen almost every permutation of situation. But what really springs to mind is I worked with a lovely couple for many years, beautiful plan. They executed on it. They did everything we said. Um, Really great mortgage strategy, creating wealth. They emailed me a few years back to say thank you in terms of the options that they had created for themselves through working with us. Their young son had been diagnosed with cancer, and the mum could stop working and look after that little boy, and they were able to fund a trip overseas in terms of treatment. That is what we want for you in terms of options for you and your family. I think that's really important in terms of that is the heart of what we do at Enable Me. Of course, ideally, you did all of this 20 years ago, but if that's not you, the second best time is today. And I always think, well, time's going to pass anyway. Best use it to the best of your ability. And for those who are older and you're thinking, is it too late? It is never too late. But in terms of runway, if it is short, it is a non-negotiable to me that you are more tactical and strategic in terms of how you execute around that plan. And you don't have to bet. I don't care what anyone tells you. You do not have to bet everything on one approach. I know this is a property webinar. I know that. But property is awesome if you do it well. If it's part of a broader plan and you are doing other things. And in fact, for most people, you do best with a blend. And diversification just means spreading across different investments so no one single wobble can knock you off course. And the right mix is really personal, and getting it right for your situation is exactly the kind of thing we are mapping out for you as clients and what we would love to assist those who are new to us. And I'm just going to reiterate this. Something I find really useful to share with clients is the idea of sequencing. And I've already mentioned it, but I'm just going to highlight it in terms of you assessing how property fits in that broader plan for you. And property investing done well, optimally, is really one isolated decision. For most households, it's part of a sequence. And where you are in the sequence, it matters a lot. So a typical sequence might look something like, and knowing there's always differences, and again, this is why we have a personalized approach. But first, we strengthen that home mortgage position, get that debt working harder. Do you have to be mortgage free on your home? I've already said no, but you have to be optimal from a cash flowing perspective. And then you make sure the rental, if you have one, can be held without ongoing pressure. We always stabilize before you grow. And then we're looking at that structural risk where possible. Think about what happens if rates rises or income changes, and that's where that resilience piece is really important in terms of having buffers and options embedded within that financial position. I'm a great advocate of having a really good buffer in terms of revolving credit if you have debt that you can draw upon. And then decide, do you buy again, diversify into other assets, or start simplifying ahead of retirement? So that is the sequencing. The point is, honestly, the next best move almost always depends on where you're at in the sequence. And jumping ahead, skipping a step is where a lot of people create unnecessary pressure in terms of sustainability. And I think one of the most useful things we do in a coaching session is just help someone figure out where they actually are with an independent eye in that sequence and what that means in terms of what comes next. And again, property is a really powerful wealth tool. I genuinely believe it. I do it myself. I've got multiple properties. I'm just about to buy another. It can be leveraged. It builds equity over time. It can eventually support income. It feels real in a way other investments sometimes don't, but it also has characteristics that need to be planned around. It's concentrated, often your biggest asset. It's illiquid. You can't sell a bathroom if you need cash quickly. And it's demanding. It asks for time, attention, and ongoing financial headroom. It really does. And that's why we always look at property alongside the other elements of a plan. Debt, cash flow, KiwiSaver, insurance, really important. Investment outside of property and retirement timing. A great property decision, honestly, can be undermined by an underfunded retirement. Even an optimized mortgage can be wiped out by underinsurance, and everything is connected. And I think that's really important to have that holistic view. It is not optional. It's just how good financial planning works. And you can't keep doing what you've always done and expect a different result. That's just maths. And if you want an outcome that's different from the crowd, you have to do something different. And something different isn't one heroic move. It's really not. It's the right mix of small, deliberate things done consistently. The solution, I think, is really personal, and that's the whole point, and it's why generic advice so often misses the point and it misses opportunities. And I'm going to call this out because I think there are lots of things that we tell ourselves to make ourselves feel better. Is now the right time? Should I wait for better rates? Can't I just figure this out myself? Should I wait until things settle down? Good luck for that. They all feel really sensible and they are all costing you. I promise you, there is never a perfectly calm year. Look at the roller coaster we have been on. Yes, it's an election year, plenty of noise offshore, but don't let that be the excuse holding you back. The cost of doing nothing really shows up on a statement, but it's real and it compounds. And I think often the beauty of working with a financial expert is they are in your corner. They can give you the confidence to act when it's hard, because at that edge of the cycle, that is often you are setting yourself up for that next upswing in terms of what comes next. So, some key takeaways in terms of, okay, great to hear Katie talk. I hope you feel inspired. But to be clear, we are not in the inspiration business. We are in the transformation business. So, how do you transform? You take really good action. So, for three things you can start to think about this week, I want you to check that mortgage structure. Even if you're in with us in program, I want you to check that. I want you to be across that. Like, but that's small tweaks that they compound fast. I want you to look at your real monthly surplus, work out what's actually left after the essentials, and that's your starting point. And for our Enable Me clients, you should be all across that, but just review it again. Is it right? Could you do better? Do we need to tweak that? Because remember, that's our anchor going forward in terms of the life we want to lead in terms of our retirement. That is our North Star. And automate that gap, redirect what's left over to paying off debt, investing before you spend it. And if you're new to us, I strongly recommend you book a financial consultation. If you're already with us, I'd like you to bring those to your next consult, or I would like you to reach out to your coach and let's bring that meeting forward, or just have another conversation. I think it's really important to adjust. Nothing's locked in stone. Let's ensure you're still optimal in terms of what comes next. And I'm going to be really clear, and I know all the Enable Me clients on the call already know this and the beauty of working with a coach, but I'm going to reiterate it. So, working with us in kind of four steps that we walk together, we decide for our clients what's right for you. Property versus the alternatives, a bit of both. We structure it properly, debt, cash flow, and that sequencing piece, and we implement it over time with a written plan we work through together, because real change takes time and we help you stay on track as markets and life change. And let's address the elephant in the room. For those who are new to us, we work on a fee for service model. We charge to prepare your plan and for the advice we give. And here's why that really matters. We are salary paid. We are not tied to any product. We sit above all products, bring them together into one cohesive plan, and then we hold you accountable to it. We're independent and give expert financial advice. The only thing we are optimizing for is your financial future. Your first step is that initial financial consultation, which all our clients will remember well, where you're matched with a coach like myself. We're up and down the country. We do in-person consults as well as video. And that coach helps you see your situation clearly and works through your options with you. They'll let you know if it's the right thing for you to work with us in one of our programs, and that is entirely up to you. And in terms of what that looks like, in terms of that initial financial consultation, it is a value-packed 60 to 90 minutes with a strategic coach like myself to get you off the starting block, highlight where to focus your effort to get you ahead faster. It's that rough sketch of your financial plan, the beginnings of a blueprint for your future. And we provide value and actionable steps to take away from the FC. So we charge a fee for that value. So if you take one thing from tonight, I hope that you know that property still stacks up in New Zealand, but whether it stacks up for you comes down to the plan, not the property. And that's the shift. And I think that's what we do differently. We're independent, as you know, fee for service. So the only thing we're optimizing is your result. And we coach you to actually implement the plan, not just hand it over. So whether you're new to us or um, already coaching with us, I think the next step is the same. You've got to get that clarity and then that structured next steps. I just really wanted to thank everyone for spending your evening with us. Go well, and I hope to see some of you across the table soon. All the best. Take care.